It's tax season. Let me show you how to legally avoid some taxes. Hey guys, welcome back to the channel. I hope you're doing well and you're ready for the weekend. Make sure to hit the like and subscribe button. This helps me out way more than you will ever know. Today I just wanted to get a little bit into another way for you to invest your money for the long term so that you can retire comfortably. What I'm going to talk about today is a 401k. A 401k is named such after the U.S.'s Internal Revenue Code, section 401k. Now, the benefit of a 401k is that it's a tax-advantaged account. There's either a traditional 401k or a Roth 401k. A traditional 401k is when you get to put your money in straight from your paycheck right off the top without the government touching it. You don't pay taxes on it, Social Security, or give it to some dude named FICA. A Roth IRA is when you pay taxes and all of the other things up front, but then when you take it out of the account, once you're 59 and a half, it's tax-free. So those are really your two options for this retirement account. You can either be taxed on the front end or taxed on the back end. It's your choice, and it really depends on each situation individually. Let's say that I make $50,000 a year now, and in the future, I want to retire and be able to live off of $100,000 a year. Well, with a 401k, either on the front end or the back end, you're going to be taxed as ordinary earned income. Ordinary earned income is your standard taxes that we're all used to, that we fill out our tax forms every year. Speaking of which, it's coming up. In the case where I make $50,000 now and want to spend $100,000 in retirement a year, I would want to go with the Roth option. So I pay my taxes on the lesser amount per year first and don't have to pay taxes later when I'm taking out more out of the account. Now let's say you make that same $50,000 a year right now, but later when you retire, you want to only live off of maybe $30,000. You would want to pay taxes later when you're taking out less money per year than what you make currently, because that way you save money on taxes. But how do I contribute to a 401k? That's a great question. Now, my employer offers a 401k option. They offer a traditional and a Roth option. And 70% of employers who offer a 401k offer a traditional and Roth option. And like I said before, it really depends on your situation and what you plan on doing in retirement on which one you would rather go with. Well, my company offers a 401k, and I'm allowed to contribute part of my paycheck into this 401k. And the company also offers a match up to a certain percentage. My match in particular is 50% of 6%. So that means that if I contribute 6% of my paycheck to a 401k, they'll contribute 3%. But the real question is, how much can you contribute? And how much should you contribute? How much should you contribute is a different question from how much can you contribute. The amount you should contribute is definitely as much as it takes to get the full employer match. This is free money, and if you're doing less than what the employer will match, then you're losing money every year. Past the minimum amount it takes to get the full employer match, you should be contributing 15% of your pre-tax income to some sort of retirement account or some sort of investment account. This is a good rule of thumb to help you retire with a comfortable amount of money. Now, somebody out there is saying, I have $100,000 that I'm willing to invest. I only need $20,000 a year to live, so I'll invest $80,000 a year tax-free and make a lot of money and retire really early. Not so fast. Because it is tax advantage, there are rules that you have to follow. The first rule is that your maximum contribution that you can do, not including your employer match, is $19,500 a year. Now, you can go over this number if it's your employer that makes you go over this number. You personally cannot contribute from your paycheck more than $19,500 a year. The second thing is that once you contribute this money, it's locked in until you're 59 and a half. There are some rules and some ways to get around it and to get some of the money out, but a lot of those involve penalties, and still paying the taxes on the money in the end. If you take the money out before you're 59 and a half, you're going to pay a 10% penalty, and then you'll still have to pay taxes. So depending on how much money you take out and when, you could be paying 50% of that or more back to the government. So to avoid the 10% penalty, this is for retirement money. Save it for retirement. Now, I can make another video on how much money you need to retire, but a good rule of thumb is to take your current income, see how much you spend a year, multiply that by 25, and that should be a safe amount if it's invested in good growth stock mutual funds. So let's go back to our $50,000 example. If I make $50,000 a year, but I only spend $40,000 a year, 40,000 times 25 is $1 million. Once I have $1 million, I can safely retire and never be concerned that I'll ever run out of money. Now again, I'll get into the math and the specifics of that in another video, but for this example, let's say you need $1 million. I'm going to give you the average balance of everyone's 401k by age groups. The first age group is 20 to 29, and they have just over $10,000 in their 401k. The next age group, 30 to 39, have just over $38,000 in their 401k. 40 to 49 have over $93,000 in their 401k. 50 to 59 have $160,000 in their 401k. 60 to 69 has $182,000 in their 401k. And 70 to 79 has $171,000 in their 401k. As you can see, none of these numbers are close to $1 million. So none of these people could live off of $40,000 a year for the long term in retirement. At 70 to 79, they could only live off of $40,000 a year given the growth on their income over the next 5 years for 5 years. And that's why I'm trying to stress to you right now that you should be investing. Imagine having to go get a job at 80 because you don't have any more money to support yourself for the rest of your life. Now, if you have contributed consistently and you have a lot of money in your account and you're not worried about how much you take out, good for you. But beware, because once you turn 72, there's a required minimum distribution given out by the government, and they tell you how much you have to take out of your 401k. You take how old you are and find what the IRS considers to be your life expectancy on a chart that they give you, and take how much is in your 401k and divide that value by your life expectancy. That's how much you have to take out every year once you reach 72. Now, once you reach 72 and you have to take out this money, that's not to say you can't put it in other accounts and keep it invested, but it could turn out to be more than you want to take out at one time. There's another type of retirement account called an IRA, or an individual retirement account. Now, this is kind of like a 401k, but it's not company sponsored and the contribution limit is much lower. And if you make too much money, it won't let you contribute to it. But if you're like me and are not worried about meeting that contribution limit, then you can create an IRA on M1 Finance. They give you this option to create a Roth or traditional IRA. But outside of that, they do allow you to invest outside of the retirement account. And you can just invest in stocks and index funds as you please. If you want to get started, you can use the link down below in the description. But what I've been doing this year is I've been investing $10 a day into random stocks from the S&P 500, trying to prove or show that it doesn't take a genius to beat or meet the stock market. So I take one stock from the S&P 500 every day or 7 a week and invest $10 a day or 70 a week. And I'm going to let you know how it does throughout the year. So right now I'm going to generate my random numbers, and these numbers correlate to an Excel spreadsheet that I have that lists all the S&P 500 stocks. Whatever number comes up is the stock that I pick. At the end of the year, the cumulative sum of my account will make basically an S&P 500 index fund, which is what I recommend investing in. At 452, we have UDR Incorporation. At 86, we have CarMax. At 398, we have Robert Half International. At $229, we have Hilton Hotel. At $479, we have Westinghouse Air Brakes. At $12, we have Allegiant. And at $23, we've got one of the big tech stocks of the year, Alphabet or Google. This is their Class A, and they have a Class A and a Class C. And there you go. With $70, I've invested $10 a day for the week, and I'm letting my money work for me while I sleep. Thank you guys for watching. If you want to get started in your investing, you can use the link down below for M1 Finance or Robinhood. Make sure to hit the like and subscribe button. And until next time, see ya.